But Mission Increase here in Middle Tennessee, again, Anne Calton. And what we're going to do is just have time with Blankenship CPA and hear about this employment retention credit. Mission Increase, we were founded in 1999. We are in over 20 communities around the United States. Here in Middle Tennessee, we serve about 250 ministries. And all of what we do, we teach a biblical approach to fundraising and engaging God's people in the work. So we are about Christian ministries and helping y'all thrive and grow. And we provide education, training, classes, coaching. All of it is at no cost to the ministry. A group of local givers have contributed so that you have this as a resource for you. They care about your growth and leadership. And as is the case today, we have people who are on here who are not just staff people, but board members and people who help with the financial viability of an organization. Champions of that organization are participating. And so it's really for all who are involved with an organization to be a part of. So we also convene. We teach our regular workshops on a quarterly basis, but we sometimes hear about a topic and say, it's time to gather some other people on this and to invite somebody else who's an expert in that to share with you so that it helps with your good, strong health as an organization. And we have CJ Blankenship, Larry Chlum, and Abigail Campbell with us today from Blankenship CPA. And they're dear friends of ours. They love Christian ministry work. They work with a lot of Christian nonprofits. In fact, Abigail's whole responsibility is kind of that area. I will let them share more about just their heart for the work that you do and why they wanted to tackle this topic with us today. And we're so grateful for them coming and sharing. So I'm going to turn it over to CJ. Most of what we're going to do is they're going to be presenting and sharing with you, but we're very glad to have you here today. I'm going to begin by opening us in prayer. Lord, just thank you for gathering this group of leaders. This could be a complex topic. We're so thankful for CJ and Larry and Abigail for sharing with us today. Just help them in sharing and the presentation, but also in us in the hearing and in trying to take something that can be complex and complicated and help us to understand it simply. Lord, if this is something, these things would be beneficial for the works, let us see a path forward on what we need to do as each person representing those ministries. We thank you that we get to gather together in this way today. And we thank you for Christ Jesus in his name. Amen. All right, CJ and Larry and Abigail, I'm going to turn it over to you. And CJ's got the slides. Kathy, anything other housekeeping that we need to mention to them? I think we have a slide, the handout that you can also use. And she's going to get that to you. So anyway, thank you, CJ. Here you go.
Well, it is wonderful, Anne. Thank you so much. And what kind words. And it is just a pleasure. Obviously, my dad, Claude Sr., who our relationship is through. And we joke around here on occasion, say all roads lead to Claude Sr., 6 degrees of separation, it seems like. He's been just a wonderful leader here in the community, not only obviously in the CPA space, but the not-for-profit space, and a lot of ministries around town. Has served on multiple boards. We've helped tons of churches over the years and lots and lots of not-for-profits. And it's just so great. I had a wonderful time at breakfast that morning at the Puffy Muffin here in Brentwood, and just a chance to visit and talk about how we get to serve people. And that is one of the most amazing parts of not only what Anne you get to do, which is what we were able to connect on, but also what we get to do in our practice, particularly as we give back to not-for-profits. When this firm started in 92, which is kind of the second Blankenship, there was an original Blankenship summer back that started in 70, but we actually, my family spent some time on the mission field with Youth with a Mission about 2 years or so with the founder of that organization, and they were developing this program called the Leadership Discipleship Training School, which was kind of just, you know, in that leadership trend in the early 90s. That was a big talking point, John Maxwell, et cetera. And so YWAM was doing something similar, and we had a great time. It was an interesting journey, but that was also the same time that Blankenship was starting literally from scratch. Dad was a little bit older, second firm around. And one of those core things that was placed in his heart at that point in time was to serve the not-for-profit community. And that's been a common thread in the firm since then. And Abigail, I may get you to, if you're comfortable, to say just a quick word or two, because that is what Abigail spends her entire time here at the firm doing. Along, we've got a lot of other team members that spend a huge amount of time. We work with, you know, goodness, this year it'll probably be over 400 different nonprofits. But Abigail, I'll let you just share a little bit about your love of serving not-for-profits. Maybe even just mention kind of that specialty, that how it is different when we partner with our nonprofits, and then maybe we'll then kind of switch to employee retention credit and this specific presentation that's going to talk about how the ERC and not-for-profits in particular might look at this potential credit.
Sure. So can you all hear me okay? Okay, I have really tall ceilings in my office, so my voice just goes straight up. But, you know, I feel like the luckiest accountant in the whole world, because I get to work only with nonprofits, you know. So for me, it's a joy every day. I wake up every morning, I can't believe I get to be the accountant who gets to do this. So truly, I hope my joy and my passion for this work shines every day, you know, in my work with my nonprofit clients. And it's a very unique area of accounting. And I'm thankful to have, you know, years and years of experience working with just a variety of different nonprofit organizations. And I just get so excited, you know. And yesterday I talked with someone about sort of a collaborative space sharing effort with some nonprofits. And I was just, you know, through the roof excited to, you know, so it's everything from bookkeeping issues to tax to helping facilitate conversations about audit. We do it all. And, you know, help with fundraising events. Anne and I are working together to hopefully present. But I was telling Anne this morning, I kind of see myself as a foreign language teacher. So, you know, I get such joy in helping nonprofits understand what accounting means, you know, what the words mean. And to me, it's so much more than just numbers. You know, it's truly supporting the organization. So I could talk about it all day, but I'll stop now.
And I will say we've got something else we're working on with Abigail and I think another co-worker there at Blankenship about just some good practices and some things related to just a good healthy practices for nonprofits, just in how your giving is done and other things like that. So there's some things that we want to share and just things that we've seen people struggle with in the past that how we can make some processes really effective for you. And so anyway, stay tuned. We've got that coming on into the fall. So we're excited about that. Let me also ask one question for CJ as y'all move into this. There might be questions. Let us know if you want to wait to a certain time or pause at certain times to see about questions, or you just want them as you go. That's your choice. But I just wanted to offer that other piece of housekeeping we hadn't discussed.
Yeah, that's perfect. In that vein, maybe what we do over the year or two here that we've been having to do a lot of Zoom meetings, it feels like sometimes that chat works pretty well. And so if anybody, just as you're going, because we don't want anybody to forget a question, and we'll try and just keep an eye on the chat. And sometimes we get distracted by the chat, so forgive us. But we'll keep an eye on it and try, and before we go from one slide to the next, just pop it in there and we'll try and answer it on the fly. I think we've got good time. We tried to kind of condense this down, and there is a little bit of technicality in some of this, but we're trying to not go too deep in the weeds. This is really meant to try and help us think about it and really see if, as a not-for-profit organization, you might consider exploring the employee retention credit a little bit more deeply. So, and so I'm Abigail, thank you. What a great introduction and to who you are, and candidly the love that a lot of us have here at the firm for serving the not-for-profit community. It is a huge part of what we do. And we have some really amazing people like Abigail that have great experience. And again, with, I think I mentioned earlier, close to probably 400 different nonprofits will serve. I think audit probably about 100 of those or so this year, Abigail, and maybe actually with the governmental, probably a little bit higher than that. And so I think we have about 40 reporting entities to the state as well. So, 100, 150 or so audits around the non-for-profit community as well. So kind of all those different pieces. And then we get into consulting with our nonprofits. That can be everything from formation to a merger, a divestiture, working with the state attorney general around some of those processes and good attorneys here in town. And so in that consulting world is where Larry comes in. So Larry, my goodness, you talk about God providing for us. Right before the recession, or I should say the pandemic hit, we were so lucky to have Larry come on board and join us. He moved back down here, or moved to Tennessee to be closer to family. And as that transpired, well, I say to be closer to family, a little shift there on the family side. But as he made that move down here, we were super blessed to get introduced to Larry and to have the opportunity to bring him on board and be a part of our consulting group, and particularly leading as a senior consultant in that space. And then as the world opened up, Larry has a great background in not only as a public accountant with Big Four in his earliest career, but then also spent extensive time in the banking sector, particularly with a little bit of some insurance integration in there as well. And then came with us with a focus initially to do some tax work and do some consulting work. And then all of a sudden, when the pandemic hit and we just started getting new laws, it felt like every couple of weeks, right, Larry? Larry ended up just becoming, the specialist here at the firm, and I would contend one of the best in the state around all of the relief, just amazing provisions that came out over the course of the last year and a half, roughly. I guess it's been a wild journey and lots of new laws. And so, Larry, we're just so grateful to have you here, not only at the firm, but especially on this call, because this is an interesting subject, isn't it?
It certainly is. And thank you, CJ. It's been a real, very rewarding trip for me and for Blankenship as a firm to assist our clients through what has been a really, really difficult time. And so I've spent about 90% of my time in the last 22 months just monitoring various bills that are coming through Congress and relief provisions, opportunities that Congress has provided to help businesses and nonprofits get over this very difficult time. And so it's been very rewarding. And I'll echo what Abigail said. There's nothing more rewarding than when I go home at night and know that I've helped a nonprofit get some COVID relief, and I know where that money's going, and it's always being used in such a fantastic way. It's just very, very rewarding for me. But from PPP consulting to employee retention, it's been fantastic for our clients and particularly for our nonprofits. But the employee retention credit is just something that a lot of entities, a lot of nonprofits, and even business entities have overlooked. And a big reason for that is throughout much of 2020, the way the law was structured is the employee retention credit was not available to anyone who had gotten a PPP loan. And so most entities were ineligible for the employee retention credit. That all changed on December 27th with some new legislation that repealed that particular rule and said retroactive back to the first day of the CARES Act, back on March 13th of 2020. Even if you got in a PPP loan, you can now go back and get the employee retention. So we have a lot of clients now going back and taking a look and saying, hey, wait a minute, now I have to pay attention to this. What was I eligible for the employee retention credit? Because this is a very, very significant benefit. In 2020, it can be up to $5,000 for each one of your employees. So we really want to take a look here and see if we can help you on this.
That's exactly right, Larry. And for the reasons that you just stated, it really was off the radar. It was one of these things that we kind of referred to as a consolation prize for those people that didn't get triple P monies. And the reality of it is, I guess we're starting to get into some of our meat here. So I tell you what, I'm going to do our required disclosure under Circular 230. Have a real conversation with us. Don't just watch this video and make a tax decision based off of what you hear here. We are required to do that for Circular 230 and a variety of other reasons. But we are going to talk about a lot of tax law here. But please, have a conversation with your CPA is the best way that I describe that, or us, or someone that's competent in this field, obviously. And we are going to run through primarily the employee retention credit. At the beginning and the end, we kind of sandwiched around it, put a little bit of a nice flavor around just some quick thoughts on smaller PPP loans, and then the FFCRA, the Families First Coronavirus Relief Act. We're going to just talk a brief moment about that, because there's still a little bit of some things to be had, especially with the Delta surge that's kind of transpiring out there, and a lot of people that unfortunately are not feeling great. And so we will put that all in there. And so I want to come back to that employee retention credit here just in a second, but to kind of keep us moving through it, in the vein of the PPP, which is really what drove the Paycheck Protection Program loans. Everyone, I mean, that was kind of after everyone got over the hump of, am I taking government or not, particularly in the not-for-profit space? Is this government money? Is this a government grant? A lot of times certain organizations maybe are a little reticent to engage in that process with government money, so to speak. And then we kind of realized the PPP was structured different than a typical government grant. It was obviously a self-forgiving loan as long as we used the funds for intended covered costs as authorized by the legislation. That being said, it was really government's way at that time to try and get money into the economy. And it was super successful, Larry. I mean, we were able to see just so many of our clients be blessed. Obviously, remember the multiple rounds of funding, and almost all, very, very, very few of our not-for-profits landed in a place where they were unwilling to take the PPP benefits. I mean, Larry, I'm aware of very, very few, and only those that really had a large endowment, potentially, things like that. But this was opened up to the not-for-profit community, and people jumped on it very aggressively.
Yeah, I mean, it was open for non-for-profits, and churches in particular could have taken advantage of this. I have a friend back in Chicago who works with a credit union that helps Lutheran churches primarily, and he did over 100 PPP loans for Lutheran churches. So it was there. Unfortunately, the program is now over. The last PPP loan was made on May 6th. But we still, many organizations still have to go through the process of obtaining their forgiveness. So that is an application process. If you've gotten a PPP loan and haven't gotten forgiveness yet, you want to submit your forgiveness application to your bank. And most recently, in the last few days, the SBA has opened up a direct forgiveness portal if you want to do it that way.
That's great. And for those who haven't quite filled out that application yet, that may be a good thing, depending on the facts and circumstances, which we're going to get into today. But also for those PPP loans that are less than $150,000, there was some streamlined reporting that came out that allows you to have a little bit easier of a forgiveness process. Not a real change in the calculations at all per se, but not necessary to send the same amount of support. For the larger loans, there's a lot of documentation depending on the nature of the credit being, or the forgiveness being claimed, and the underlying covered costs. But for these smaller loans, Larry, really easy process.
It's an extremely easy process. This also was part of the December legislation that provided for the simplified form. It's called a Form 3508S, and it's truly one page, and you really only have to put on it two number figures, the payroll cost you incurred during your 24-week period, and the forgiveness amount you're requesting. And then you sign the document, initial in 2 spots, and you're done. The simplicity of it does provide somewhat a one particular landmine, and I've cautioned a lot of clients, be careful. It's so easy to jump in and fill those 2 numbers in and move on, and the bank really wants you to do it because the bank wants to have this all behind them. But I say, be careful. And we'll get into more details here in a minute, but you don't want to put that payroll number down too quickly, because we want to use your payroll to get the employee retention credit if you can. So have a discussion with your accountant or your CPA before you fill this form out, just to make sure particularly if you're going to be eligible for the employee retention credit. You want to give a thought or two before you just fill the form out.
That's exactly right. And to that point, we're getting ready to get into this a little bit as we run through here. But these expenses that you claim as covered costs for Triple P, we can't use those same expenses in the employee retention credit. And that's why this slides up here really is just to kind of hit the pause button on that Triple P forgiveness application process if you think that you're going to be eligible for the ERC. If you've already filed the Triple P forgiveness process and received forgiveness on that loan, or even really honestly just filed it, and are going to receive forgiveness for that filing. If it gets denied, there's a whole nother conversation, which we probably won't spend much time talking about today, but the short version is that you can still claim those denied Triple P costs on a ERC claim. But the short version of it is can't double dip, and so as we get into the ERC now, it'll be important for us to just kind of keep that in the back of our minds. But we're going to just start kind of getting into a survey here on the employee retention credit itself, how it works. As Larry mentioned, there was one set of rules when it first came out as a consolation prize at the end of 2020. It was liberalized, opened up for everyone, even if you had a Triple P loan. And that's why nobody is really taking advantage, or very few people are taking advantage of this early on. And we are like, screaming it from the rafters. We're on the rooftop saying, guys, look, you got to see, for all of our clients, not just our nonprofit clients, it is incredible how many clients are eligible for the employee retention credit that just aren't hearing it. We've blasted emails. We've sent out notes that say, hey, you could be missing $28,000 per employee, and then you only still have maybe, 10, 15, 20% that even look at that, right? And for a fact that people are eligible for this. And so we're screaming it from the rooftops. Let's listen, kind of listen in here for a little bit and say, hey, can I get into this employee retention credit? And I think it is important that as we think about this, just like some of that hesitancy around the Triple P loan, this I would say is even less so of a sense of hesitancy, in my opinion, just from a factual standpoint on, quote, taking government money, so to speak, because this is really just a credit, isn't it, Larry? This isn't even like a grant.
Right. So the employee retention credit works through your payroll tax returns, and it's a refund of the employee or the employer payroll taxes that you've already paid. So it's not a grant. It works through the payroll tax system.
Yeah, and that credit process, and there's a lot of credits that not-for-profits potentially are eligible for that have been a part of the tax code for a long time. And, research and development credit, there's some other credits that get out there. And so you'll see a normal credit process that runs through the not-for-profit. I think it's just important to say, guys, this isn't a grant. This isn't even a conversation in my mind from a board level perspective to say, you're going to talk to your board about it, obviously, but to say, hey, if the conversation comes up, are we taking government money? Is this just another grant? And there's hesitancy around that if you're a church or otherwise. And it's like, well, no, this is a tax credit. It is something you are entitled to under the tax law, which for a lot of not-for-profits that are filing 990s, this will be a familiar process. For churches that aren't filing 990s, well, you're still filing that quarterly payroll report all the time, assuming you have employees. And that is going to be part of that normal process. And that's the point here. We operates through the 941, which is your quarterly payroll tax return. Those forms have been updated to appropriately report the employee retention credit. We had a big update on the 941s for not only FFCRA, also the ERC. And that is the process that's going to work for it. Now for 2020, basically, you're going to be doing those on amended returns. For 2021, you may have some amended returns. You may have some real-time opportunity, depending on the nature of it. And we have some really different rules, Larry, for 2020 versus 2021. We're going to get into those details, but the end of the year when the 2021 Act 2020 came out, the Taxpayer Certainty Relief Act, it opened up the world on this, not only from an eligibility standpoint, but prospectively for 2021, that credit, which was originally this roughly $5,000 per employee max, all of a sudden just blew up, didn't it, Larry?
Yeah, we went from having a maximum last year of $5,000 per employee to a maximum this year of $28,000 per employee. So this year in 2021, the credit is capped at $7,000 per quarter. So if you're eligible for all 4 quarters, for each employee, you could get a credit of up to $28,000. I will mention just in passing that the infrastructure bill that's currently pending in Congress would eliminate the employee retention credit for the fourth quarter of this year. But if that passes, we still are going to get 3 quarters, $7,000 each quarter maximum in 2021.
Thank you, Larry. And, as we mentioned earlier, you do have to integrate with the PPP when applicable. We'll spend a little time talking about that today. But the success stories, and I think we just wanted to kind of highlight for our nonprofit friends here, the reality that we are seeing great success stories on this, aren't we, Larry? And my goodness, to Abigail's point, and what you said earlier, Larry, when you go home at the end of a day and you've helped not-for-profit literally go and pick up, 10, 20, 50 plus $100,000 sitting on the floor. It's just sitting right there on the ground. Just go pick it up. Man, it feels good, doesn't it, Larry?
It really does. And I could give you a couple of examples. We have a nonprofit that provides a safe space for at-risk teens. We did ERC for them, and they got a refund of over $66,000. We have another client that is a fundraising organization that provides support for medical research. We did a ERC filings for them. They got over $54,000. We have another non-for-profit that serves individuals returning to society from prison with a Christian focus. They got over $62,000. So it's real money. It's not it's not an insignificant amount of money for most organizations that have employees.
Those are some great stories, Larry, and thanks again for leading that charge for our entire consulting group and the firm as a whole. It's just really special, really special. So as we mentioned, $5,000 per employee in 2020 and up to $7,000 per employee per quarter. And so 5,000 for the whole year of 20. It's based off of 50%. We're going to talk about this a little bit more, of up to $10,000. And then for 2021, it's up to 7,000. It's a 70% threshold per quarter. Again, up to $10,000 though, instead of for the year, for each quarter. And so that's how we get to that $28,000 number. And so all of a sudden, it'll be interesting to see what happens on the fourth quarter, because I think there's some people we're going to talk a little bit about it, later in the deck, that might be planning for that fourth quarter potentially. Now that kind of the awareness factor is out there, we'll have to see what happens. That's something close to watch. So who might qualify, Larry? You mind kind of just sharing a little bit about kind of we kind of focus on 2 doors historically. There's a third door that's out there, but now we've had to kind of say, hey, we got to think about this third door, but really primarily 2 doors to get into this.
Yeah, the 2 most common ways to qualify for the employee retention credit is either through a decline in your gross receipts, or that your organization was subject to a government-issued COVID order that partially or fully suspended your operations due to restrictions on commerce, travel, and group meetings. So let's talk about their gross receipts test first. So it changed from 20 to 21. Last year in 20, the organization must have had a 50% decline in gross receipts in any calendar quarter compared to the same calendar quarter in 2019. And what we were commonly seeing was this was happening in the second quarter of last year when COVID was at its worst and we had the wide-scale lockdowns. A lot of organizations at that point were seeing a greater than 50% decline in gross receipts. Once you met that threshold, so for example, if you met the threshold in the second quarter of last year, you continued to be eligible. This is a mouthful, until the first day after the first quarter in which your decline in gross receipts was less than 20%. So let me give you an example. If you're an organization and you had a decline in gross receipts in the second quarter of last year of 55%, you were eligible in the second quarter, and you knew right away you were also going to be eligible in the third quarter. If in the third quarter you had a decline in revenue of 21%, you maintain your eligibility. So now you're going to be eligible for both the second quarter, third quarter, and the fourth quarter. But if we go back and say, well, in your third quarter, you didn't have a 20% decline in revenue. Your decline in revenue is only 19%. Well, now you're going to be ineligible on the first day of the next quarter, which would be October 1st. So that's how it worked last year. As we move into 2021, that December legislation changed the rules. And it said, okay, now for 2021, you must have a 20% decline in gross receipts in the quarter compared to the same quarter in 2019 still. And this is important. So in the first quarter of 2021, we're going to look back 2 years to see whether you have a 20% decline in gross receipts. And if you do, you're going to be eligible for that first quarter. And here's a little twist on it as well. The government allows you to also look back to the prior quarter, what we call the alternative quarter. So in the first quarter of 21, we're going to test both the first quarter's revenue, and we're going to step back prior quarter to the fourth quarter of 20, and we're going to compare that to the fourth quarter of 19. We're always comparing to 2019. So if you had a 20% decline in gross receipts in the fourth quarter of 20 versus 19, you're going to be eligible for ERC in the first quarter of 21. So each quarter this year, we're going to test to see if you have a 20% revenue decline for the current quarter and the immediately preceding quarter. And once you're eligible, as CJ mentioned, 70% of up to $10,000 of wages for each employee. So the dollar amounts get large very, very quickly.
Absolutely. And one of the concepts that's here, especially for last year, is once you're in at that 50% decline for 2020, all the subsequent quarters, and so this is all kind of this door number one concept here with this gross receipts decline, you are eligible for all those subsequent quarters until we get back to that 20%.
Correct. Correct. Now I see a number of questions coming in the chat about how we measure gross receipts, and the measurement is really quite broad for a non-for-profit. So we're going to include contributions. We are going to include all of our receipts without any reduction for cost or expense. So for example, if you have an annual fundraising dinner and you sell the tickets for the dinner, obviously that ticket cost is going to include the cost of your dinner. That you must include the gross amount of the ticket sales. You cannot reduce for the cost of the caterer or any of that. If you happen to have an endowment or other investments, for example, that donors have given you over the years, if you sell one of those investments, you have to include the entire amount of the sales proceeds in your gross receipts. So the IRS defines gross receipts very broadly in this context. But there's a second door that we can go into.
And Larry, I might just add one other quick thought around exactly what you're talking about here around this broad definition of gross receipts. Potentially, gross receipts could even include something like if in 2019, for instance, you had a large trend like a building sale or something along those lines. Would that help potentially drive up that base figure for the?
It absolutely does. I was working with one client and with their controller, and initially they came back and said, "Oh, we don't qualify." And subsequently, I looked at some of their financial statements and I called the controller up and I said, "It looks to me like you qualify." And he said, "No." He goes, "These receipts, these contributions we got back in 2019 were for our capital campaign." I said to him, the IRS does not care what you call it. If it was a gross receipt, it was a gross receipt. The only thing we're going to exclude from that definition of gross receipts is your PPP loan and forgiveness. But if, for example, you got a grant, so you got a CARES grant, that's going to be included in your gross receipts. So it really depends on where it fell. I mean, obviously for this purpose, for qualifying for ERC, you want to have higher gross receipts in 2019 and lower gross receipts in 2020. But we'd have to do that testing. But there's another door. And I think for many of and this is a good thing, for many of our nonprofit clients, they don't qualify for the gross receipts test because their supporters, their donors have stepped up and they kept giving. So I've talked to a number of nonprofits and said, "No, we're fine." Everyone kept giving. A lot of churches, no, folks weren't coming to church. They couldn't come to church, but they kept giving. Well, there's a second way to qualify. And that is if your organization was subject to a government issued COVID order I'll use the word order, that partially or fully suspended your operations due to limitations on commerce, group meetings, or travel. And that group meetings is really important for many, many nonprofits. So what do we mean by COVID order? Well, first of all, it has to be an order. It has to be mandatory. If you have guidance or suggestion from like, for example, the CDC suggests that you do, that's not an order. I always tell the clients, an order means that if you don't do it, you're going to get fined or go to jail. It has to be mandatory. But that being said, we have many orders here in the Nashville area that were in effect last year. The most common one we see clients encounter is the Safer at Home order issued by Davidson County that limited group meetings and commerce and travel that is going to qualify you for the employee retention credit. But one of the examples I throw out commonly is with our church clients. If you could not have Sunday service because you could not have a group meeting of, say, more than 10 people, you're partially suspended. That's a more than nominal, your church service on Sunday is more than a nominal part of your operations, and you're partially suspended. While that order is in place, restricting the number of folks who could come to Sunday service, restricting the number of folks who could come for your service, you're partially suspended. And the wages you pay during that period of time are going to be eligible for the employee retention credit. Now, you've got to be careful, got to monitor those orders. The orders were amended and altered throughout the year. When an order got amended such that your organization was no longer restricted in that fashion that I talked about, then your eligibility period stops. But for many of our clients, the orders that were out there made them eligible for most or all of 2020.
Yeah, and that's a great point, Larry, that you just brought up here. Whereas in, call it door number one, the gross receipts decline. Once you're in it for a little while, not only for the whole quarter that you've met the eligibility requirement, but then you get to stay in it until you are back above basically that 80% mark, a 20% decline. So once you restore back, you're out, and it's on a quarter by quarter basis. Whereas the government order starts with the date that the order came into effect and ends with the date that the order ceased.
Correct. So for example, the Safer at Home order went into effect on March 23rd of last year. And so many of our clients are claiming the ERC for their payroll that fell within March 23rd to March 31st. And then we have to look to see if they're eligible later. But if, for example, their eligibility fell off on November 25th, then wages paid after November 25th are not going to be eligible.
That's right. And some questions are starting to kind of pop up a little bit here around, well, which county had this order, and where were the state level, what were the county level, and were there things similar? And so there is a wide amount of county orders and or state guidance that came out that potentially can apply in facts and circumstances. And the IRS is dealing with this. And early on, again, I'm not going to say nobody, but very few people were paying a lot of attention to the employee retention credit. And, basically those that had not received triple P for all practical purposes and would still potentially be eligible. And so in the meantime, you had all these frequently asked questions that had started coming together, and, we weren't really paying attention to it. And then all of a sudden at the end of 2020, it opened up, and there was a great resource out there from the IRS that has a lot of Q&As that talked about it. All of a sudden, like, oh, wow, this is great. And then we started kind of referring to this quite a bit. And then a series of notices came out, as we talk about down here below, that then followed the Taxpayer Certainty and Disaster Relief Act, and then ARPA as well, that then came out as Biden's first sort of signature bill that he passed for relief once he came into office, and then a recent notice as well that came out. So all these notices then basically took all the questions and answers, started adding some pieces to that, and so there's a huge, almost treasure trove of examples out there of when these government orders that limited commerce are applicable to a particular taxpayer, Larry. And I mean, those have been really helpful, haven't they?
They've been very, very helpful. Some of the examples they give, for example, with respect to restaurants, are very informative in our non-for-profit space. So, for example, they give an example of a restaurant that has indoor dining facility, outdoor dining facility, and carry out, and they go through and say, when the restaurant had to close its indoor dining room, but it could still serve through the drive-through. Was it suspended? And the answer is yes. And then they go on, IRS goes on to say, well, how about if they could add outdoor dining? And the IRS said, well, if indoor dining is a non-nominal, a more than nominal part of their business, they're still suspended. Then the IRS went on to say, well, how about if they could open their dining room, but because of spacing restrictions, so in other words, they had to be spaced 10 feet apart. The dining room is at 50% capacity. And the IRS said, you're still partially suspended. Well, think about that, the implications of that with respect, for example, for church. You know, if you have a church that can hold 16 congregants at a time, and you space according to a government order that you were subject to, which said, you know, you had to space people 20 feet apart. And then once you did that, you can only fit 200 people in the church. Seems to me that that's more than a nominal part of the services you're providing. Seems to me you're partially suspended. So I would think that you would qualify. So it's important. The examples are very illuminating. They talk about in businesses, for example, and this may apply to some of our not-for-profits. If you're able to provide your services or work remotely, you would not be considered suspended. So now that has very limited application. If in what you do in your mission is actually being face-to-face with people and assisting people, it may not be something that you can do remotely. So, for example, they give an example. The IRS gives an example of physical therapy business, and they were meeting all of their clients face-to-face before the pandemic, but then after the pandemic, they provided some services via Zoom and other remote services. But the IRS went on to say they still could not have the patient in the room with the equipment and helping them. Would they be considered partially suspended? And the IRS said yes, because some of the patients needed the equipment, or the physical therapists needed the equipment to provide the service, and they could not do that remotely. So that business was considered suspended.
Larry, you can extrapolate that in the not-for-profit service space pretty easily. There was a question, this came up in the chat, that was a good, hey, we couldn't go into the schools to do what we do. And so clearly, obviously that was a government order that shut down the schools, and you'd be subject to that inability to operate at the same level. But even as folks became really creative, and that's one of the fun parts of the that's not the right word. That's one of the encouraging aspects through the pandemic, was the innovation and the adaptability, particularly of a lot of our not-for-profits and clients we've been blessed to work with. People adjusted and found ways to still serve. And so, but to your point there, Larry, just because you adjusted and found ways to serve, if you were still limited in that ability to serve, and you can show that economic impact oftentimes, you're going to be eligible through this door for that period which was affected.
Right, because when the IRS looks to determine whether or not a more than nominal part of your operations were affected, we're looking back to 2019. They're using 2019 as, well, this was the year before we had some abnormality. 2019 was sort of the normal year. And so we look at whether a part of your operations was more than nominal by looking at the number of employee hours or the amount of revenue you got in that period. And if it's more than 10% of either of those factors, that part of your operation is considered more than nominal. Now, that's difficult to extrapolate over into the nonprofit world with respect to revenue, but maybe with respect to employees, it is. You still have to provide services to meet your mission. And if you're using employees to do that, and more than 10% of your employees are affected by some kind of a restriction, that's more than a nominal part of your operations.
That's exactly right, Larry. And so one of the things that we put together, so throughout the course of the pandemic, we had this thing we called our What Matters Most Matters More blueprint that talked about how to think about all of just running a business in general terms, and particularly the financial ramifications in the midst of the pandemic. And so we put together these flow charts basically that would oftentimes serve as a, this old saying, a picture's worth 1,000 words, right? Well, maybe it's worth a couple thousand. We've been talking for a little while already. So we have a flow chart here that kind of helps us, and we've updated this. And I'm sorry, I think there's an occasional march that pops up at the bottom of this. This was updated for this presentation. Forgive me, that used an old deck from something we did for the Tennessee Society of CPAs in a tab meeting as well, and put some of those pieces together. So forgive me, there's some master slide references. This is an up-to-date presentation. It's not based on March. And this is an up-to-date sort of flow chart that we put together to help us, particularly as not-for-profits, to think a little bit about the eligibility of the Triple P. And so we went through all of these. We've talked a lot around some of the law and some of the nuances and some of the examples, but this process really serves as a great tool for a not-for-profit or a for-profit entity to ask themselves, am I eligible for the ERC? And Larry, as we kind of look at this and we talk about door number two, so we wanted to first kind of run through some of these high-level concepts. Big picture, how does this work? Where did it come from? Why is it different in 20? And why is it different in 2021?
So Congress and the IRS came out and defined a non-for-profit a tax-exempt organization as being engaged in a trade or business for this purpose, which opens the door for our nonprofit community. And then we go to the two standard doors. Did you have the requisite decline in gross receipts? If you did not, were your operations fully or partially suspended due to the issuance of a government COVID order? And if you meet either of those two tests, you're going to be eligible for the credit. And then we want to determine how much is the credit. For larger employers, last year, over 100 full-time employees. In 2021, over 500 full-time employees. You only got the credit for wages you paid to employees who were not working. If you're under those thresholds, so last year, in 2019, if you had fewer than 100 full-time employees on average, you got the credit on all wages, even employees who are working. And for 2021, if you had fewer than 500 employees, full-time employees on average in 2019, you're eligible for the credit on all wages, whether or not the employee is working. And it's, as we mentioned earlier, it's 50% of the first $10,000 of wages last year, and 70% of the wages up to $10,000 for each quarter in 2021.
Absolutely. And then that's when we get to, so at this point in time, you've gotten through one of the two doors, and we've got a little reference here to the recovery startup. I'll come back to that in a minute. I want to confuse our conversation, but we've gotten through one of the two doors. And then we've determined, once we're in those one of two doors, and which year, what those qualified wages are during that period, those that are paid during that period. And so during that period, then we look and say, okay, well, how much in wages was paid to each individual? Was that below the $10,000? And then what percentage, based on which year it is, either 50 or 70% of those said wages during that eligible period, then becomes eligible for the credit. Now, then we have to think and say, okay, well, did I have a triple P loan? So we have to start by saying, what are those wages? When were they paid? And then if you had a triple P loan, there's really going to be two things that you have to consider. So if you've already asked for forgiveness, then we have to think really long and hard about what we already asked for forgiveness for on the triple P loan forgiveness application, because we cannot double dip. We can't both get an employee retention credit for those wages and receive forgiveness. Now, it is important, forgiveness is better than the credit, right? Forgiveness is just a dollar for dollar straight benefit. The credit is a dollar for dollar benefit, but we have a reduction, but it's based off of a percentage of said wages, right? And so in the nonprofit, and if you're in a for-profit community, you actually have some tax ramifications that come in as well. In the not-for-profit community, assuming it's not part of UBIT calculation, then this wouldn't be as big of a deal. But it is a percentage, either 50% or 70%. So dollar for dollar, we'd rather have the triple P. But ideally, Larry, if we're able to get ahead of it, so we haven't already filed that triple P loan application, or we filed it and we can look at those periods and we might find some overlap depending on what we actually put on that triple P loan forgiveness application, then we would want to integrate those dollars and claim those that we can maximize, obviously try and particularly use other covered costs. So we had a long list of other covered costs that would potentially be eligible for triple P forgiveness. We would want to utilize those first if we haven't yet filed the application, and then only use those ERC eligible wages to the degree that we need to make sure we stay within the parameters of the triple P forgiveness. And then we would use all the residual dollars in that same overlapping period to claim the employee retention credit. So that's a lot of information, Larry. You may do a better job of me trying to simplify that a little bit, but that integration process gets a little bit squirrely, doesn't it?
Yeah, it does. And unfortunately, this is an area where we think the IRS came out with a ruling that is quite unfair to organizations that filed their PPP forgiveness application early. And I can kind of highlight, or maybe expand on what CJ said. I'll give you maybe a simple example. Let's take an organization that got a PPP loan for $100,000 in May of 2020. And that organization went ahead in November of 2020. Their 24-week cover period was over. They could file for forgiveness, and they submitted a forgiveness application. And on that application, they said, "Well, I had $100,000 of wages. I'll just put the wages on there, and we're done." Frankly, back last year, I did several of those applications for clients. Why wouldn't I? And the banks were really encouraging you to say, "Look, if you've got enough in wages, just put the wages on the form, and you're done." Well, unfortunately, those $100,000 of wages that you use cannot be used to claim the employee retention credit. Now, let's say a similarly situated organization got a $100,000 PPP loan in May of 2020, but they decided, I'm going to wait. I'm busy with other stuff. I'm going to wait. They didn't file their PPP application until July of 2021. And they heard about this employee retention credit. And they said, well, wait a minute. The only requirement for me is I have to have at least 60% or $60,000 of my forgiveness amount has to be for payroll costs. So I'm going to use $60,000 of wages, and I'm going to use $40,000 of other costs. That could be interest on my mortgage, rents that I pay, my utility costs, certain other costs. I'm going to put down $40,000 of other forgivable cost on my forgiveness applications. Still got $100,000 of forgiveness, but what the second organization also got is they only have to reduce their ERC eligible wages by $60,000, not by the $100,000. So that second organization potentially could get an extra $20,000 in employee retention credit.
That's right, Larry. And the other aspect too is depending upon when in the cover period, which quarters the eligibility might exist for the ERC, or what that period that we were subject to that government order might look like from a week-to-week basis. You can pick and choose, because again, that covered period was a 24-week period that got extremely expanded. You could pick and choose, well, I'm going to use these that were in the first part of the triple P cover period for the ERC, because maybe it was that second quarter and I got my triple P loan relatively earlier, but that second quarter was my eligibility quarter. But in the third quarter, I got back to 80%. So therefore, well, I guess it would actually extend even into that second quarter, but you kind of pick and choose. And maybe it was the third quarter, for instance, that I reached the eligibility. Well, I would use my second quarter payroll costs on the triple P, but then maybe the third quarter where I had the eligibility for ERC, use those wages for the ERC. And so you begin to start kind of picking and choosing periods, right, Larry, and saying, hey, how do I get the best benefit in both of these worlds?
Right. And so when we do encounter a client that has a problem, what we do call it is coordinating the wages between the employee retention credit and PPP. What we want to do is look to see, okay, for last year, for 2020, you can only get $10,000 for each employee. It doesn't matter which quarter you paid it in if you're eligible. We have a lot of clients that got their PPP loan in in mid-April of 2020. Their 24 weeks were over, the last week of September. So we'll look into the fourth quarter and we'll say, okay, let's look at fourth quarter wages if they're still eligible. And if an employee got $10,000 of wages in the fourth quarter, those are the wages we're going to use, because we can't use those for PPP forgiveness anyways. Those wages were paid after the 24-week period. We'll also look at the period prior to the cover period. So for example, I'm not aware of any organization that got a PPP loan before April 10th of 2020. Well, you were potentially eligible on March 13th. So we could have wages between March 13th and April 10th that we paid. We're not going to use those wages for PPP. It was before we got our loan, but we can use them for ERC. And if we can use the wages paid before or after the 24-week cover period to get a particular employee to $10,000, we've accomplished our mission, and we don't have to, we weren't going to be able to use those wages for PPP anyways.
Can I just jump in real quick? I'm feeling called to say, hang in there, everybody. This is super complicated. And if we're, I had to hear this so many times. So, and CJ and Larry, it's like so easy for you all to, I just want to say this is really complicated.
It is. And we've gone down, Abigail, that is a great, Larry and I, we've gone a little deep in the weeds here. And some of that is honestly because it is, if you have the triple P integration issue and in the same period, you really, Larry, I don't want to shamelessly plug here, but you need to ask for some help. Because even we have CPAs here at the firm that basically come around the corner and say, hey, Larry, hey, CJ, hey, so-and-so, I'm not messing with this triple P forgiveness application and ERC integration. Can you help me? And these people have been doing CPA work for 20 years. And so it is complicated.
Unfortunately, when we mix the two together, it gets very complicated. If you only have PPP and you're never qualified for ERC, the PPP forgiveness is pretty simple. And if you only have employee retention credit, you never had to get PPP forgiveness, the employee retention filing is pretty simple too. But when you put the two together, it gets pretty complicated, unfortunately.
Yeah, and that can even find its way here into 2021 for people that had triple P2 who maybe potentially obviously would have some significant overlap. And so it's just, I think the big point here is if you haven't filed your triple P forgiveness application, be it for one or for two, make sure that you think through the ERC first. And and there's a process to do that. It is a little bit more in depth, but it can potentially, as Larry said in the examples earlier, it can save you a lot of money. I will take one quick shameless plug here around the recovery startup business. There's not a lot of nonprofits that started up during this period, but there are some. And for anyone that started up, be it a for-profit or not for profit, and if you're eligible less than $1 million in annualized revenue and started after 2/15 of 20, and then we're not subject to a government order, basically. So the idea, it's an interesting nuance, but you weren't subject to an order, and therefore, and you opened a business while you were subject to an order that said, hey, you can't actually do this. But in that example, if you can potentially be eligible, there's a different limitation of $50,000 a quarter, but that's out there. And so it's not just for those that were in business. It also can be for those that started after the pandemic started, and they're out there. I'm looking at one right now for not a nonprofit, but a for-profit. And so that can transpire. So we've got a couple little notes on that in here as well in the deck and the copy that you might get. So we're getting towards the end here. And so maybe what we'll do is just, and I'm not sure exactly what time we're supposed to stop, but we've got some kind of simple examples here that I feel like are really nice. It's like, oh, wow. Yeah, this is, this just really kind of shows all this points that we've run through. You kind of go through the process of qualification. And Abigail, Larry, we've got some nice examples here of just kind of, this is, really practical application of what you might see in some examples with some not-for-profits and some eligibility for the ERC.
Yeah, so here's a, we try to keep a simple example here, but in our case test here, we have an organization with 10 employees. They're making $30,000 a year each, so $7,500 per quarter. The organization was eligible for a 6-month window in the second and third quarter of 20. So we know that those employees were paid $15,000 of wages in that period of time. They are entitled to get a 50% credit on that. Well, we might have a little bit of an error on here. I'm gonna back up and say that the organization was eligible for through December, so that we paid at least everybody $10,000, and we got 50% of that is $5,000 credit. Well, how do we get it? So $5,000 times 10 employees is the $50,000 credit. Well, we need to go back now and prepare amended Form 941. So we're going to prepare a Form 941X for each of the quarters of the second, third, and fourth quarter of last year. And we're going to claim that credit for the wages paid in each of those quarters, up to $5,000 for each employee.
Yep. And I think, Larry, I think we're okay. We basically in this example said 6 months of eligibility. So two.
Oh, I'm sorry. Yeah. So we would have paid
Yeah.
$15,000 for each employee. So I'm sorry.
That's right.
So
And
that's
then-
correct.
And we would have gotten up above. So the first quarter would have been 7,500, and then we would have gotten to 15,000 that second quarter of eligibility. But remember, in 2020, the limitation is $10,000 for the whole year. And so you kind of cap out there at that $10,000 mark, even though the wages were actually 15,000. So that's a nice example of where you can see that 10,000 in 2020 coming into play. And then we'd have that eligibility. All those employees would get up to 5,000 apiece. And that's that $50,000 credit. Is that, and so Larry, am I looking at that right?
That is correct.
Perfect.
And here the IRS requires us to file those amended returns the old-fashioned way. So they have to be filed on paper. If you're located here in the Nashville area, those gets filed with the Cincinnati Internal Revenue Service Center. And then we're telling our clients to ask for a refund via check. So as you may know, the IRS has a tremendous backlog, and it's taking an extremely long time for these to be processed. But we anticipate that ultimately our clients will get a check in the mail for these refund amounts.
That's right, Larry. And that process Abigail threw in the chat here, it falls under the normal statute of limitations process. So you have about 3 years to work through this process for these previously filed returns, which is important to consider. And then, and they're in an interesting turn of events. The statute, which normally is 3 years, for anything that you actually file a credit on, actually gets extended to 5 years. And so it's an interesting sort of little nuance. We have 3 years to claim it, but we're going to keep it open for 5 years if we want to take a look at it. And just, interesting things have come up throughout the course of this process. But so here's example number 2, which I think is a nice example of 2021. And you can start seeing how this plays in, right, Larry?
Yeah, you can see how significantly the ERC has increased as we move into 2021. For a couple, it's easier to qualify because you only need a 20% decline in gross receipts instead of 50, and the credit is much larger. So here we have an organization that had a 21% decline in gross revenues in the second quarter of 2021 compared to the same quarter in 2019. That immediately tells us that this client is going to be eligible for both the second and the third quarter. Because remember, we're always looking at the current quarter and the prior quarter. So the current quarter is the second quarter and the second quarter. But when we get to the third quarter, the prior quarter is this second quarter. So the minute you qualify, you're going to be immediately eligible for at least 2 quarters. So in this case, we've got an employer with 10 employees, each making $30,000 a year or $7,500 per quarter. So each employee is paid here $15,000, $7,500 per quarter. But now we're going to get 70% of the quarter's wages up to $10,000. So each employee is getting $7,500 in the quarter times 70%. The credit for the quarter is $5,250. We're going to get that for both the second and the third quarter times 10 employees. We're going to get a credit of $105,000 for this particular client. Now here, we have a much better opportunity if we know in advance. So in the example here, we're talking about the client knowing that the second quarter has a decline in revenue. Perhaps they've already filed, or they should have already filed, their second quarter Form 941 payroll tax return was due July 31st. But we haven't filed our third quarter Form 941 yet. That's not going to be due until October 31st of this year. What do we want to do? When we file that third quarter form, we're going to mark on the box, we want a credit. Don't send us a check. We want a credit. And then we will stop making payroll tax deposits until we recover a dollar amount of that credit. And we'll get our funds much more quickly than if we ask the IRS to send us a check.
That's exactly right, Larry. And a great opportunity to hop on top of this now if someone has reached the eligibility requirements here in 2021. The government order aspect isn't really as much at play here in 2021, practically speaking. You might find some examples, but they're pretty rare. We'll see what happens over the coming weeks. But generally it's going to be this revenue decline, which has been much liberalized, you know, at the 80% mark. A lot of folks can hit this, particularly if you think about the base quarter in 2019, having encountered in the nonprofit space, something like a building sale or a large sale of something out of the portfolio. And so it really requires some analysis. And then example number 3 here, basically what we've done is just given an example where their PPP loan has not actually been filed for forgiveness yet. And we won't get into this, Deb. We talked quite a bit about this, but basically, you know, you just got to make sure that you integrate all those pieces. And so I think that, you know, we spent a lot of time here talking about all the different sort of some nuance, a big picture. And it's hard. I mean, like, forgive us, guys. You know, we're a bunch of accountants here. We just dug deep down in the weeds to run through this because unfortunately, you know, that is where it goes. And it goes there to Abigail's point earlier, relatively quickly. Larry and I'll jump right in there and start talking about some of these nuanced issues. But the reality of it is it just requires some good analysis to say, hey, is there any way at all that either one, I was eligible and I need to go back and claim it, or 2, am I on trend somehow in this, particularly as you get into this third quarter here, to hit it, you know, and go back and do that thorough analysis of the base years in 2019. Make sure you're including all the definitions of grace receipts in there, and then go back and let's say, hey, where am I lining up? Am I getting this 80% of the prior year, you know, greater than 20% decline? And it's out there, and it's amazing how often folks are eligible for this and not digging into it. And so with that, you know, sorry, we've gone just a little bit over, I believe, here. And Ann, I'll let you wrap us up. I do want to, so this is our shameless.
You're okay. We said till the hour and a half, so we've got a little bit of time. Go ahead.
Perfect.
And then I do have I already have a question, because I think there's a number of people on this that might qualify for that third thing that you said, that that they were shut down, that because of government order, their revenues were fine. Their giving was great. A lot of people had good giving, but it was this piece of them not being able to do the work that they normally do in that. So that would be a different thing. And I would assume there's a different kind of form you fill out for that, because you're obviously not talking about gross revenues. You're talking about shut down because of government.
That's
No,
right.
actually, it's going to be filed on the same form. We're still going to file an amended form 941. It's called the 941X. And the last page of that form has it's an essay question. Tell us why you're eligible. And we in that essay section, we tell the client is eligible because they had a 53% decline in revenue in the second quarter. Or we'll say the client is eligible because they were subject to the Safer at Home order issued by Davidson County, Tennessee, between these dates. But it's going to be done on the same form.
That's great.
And I'm going to pull one of those up real quick here. So let's see if I can.
And I'll let others chime in if they feel like that maybe is the place that they can put that in the chat, if you have a chat related to that. But I'm wondering if some of y'all, because I had a lot of people say, well, I don't think I qualify because we didn't necessarily giving. But I think the thing that you've said, stop and look. Stop and look and really look at that 2019, all of those revenues that come in, all of your money. Yes.
Yep, there's a schedule that goes kind of behind your normal 941 process, and then basically the credit ends up falling its way onto the form. And then to the point of what Larry said earlier, if we can catch it real time, you end up with an overpayment, and then you don't actually have to make your deposits because you have this credit that just gets applied up against your future deposits. And so,
Right.
so it's a really nice process. And when eligibility is triggered, and to your point, Ann, it would seem like, oh my goodness, this is a totally different process. Exact same process of moving through those credits. It's just how were we eligible and what were the periods that we were eligible for. And so whereas in the quarterly, the decline, the actual revenue decline, the gross receipts decline specifically for nonprofits, you know, it's for the entire quarter. But for those that were subject to the order, as long as we can show that limitation of the actual commerce, right, Larry? And in that scenario, we pick the beginning date of that order applying specifically to us. And to Larry's point earlier, if you break it, you get fined or you go to jail, you know? And so you can't be a carve out, you know, you can't say, well, I had to do this because of some recommendation from a non-governing body that doesn't actually have authority for consequences, just a recommendation. But it starts with the date of the order and it ends. And so those can be, you know, particularly like, for instance, you know, the school situation where school was closed down that came up in the chat earlier. You weren't allowed, if your work is going into the schools to work with kids and the schools aren't open, there's a government order that is clearly limiting your commerce. And until the schools open back up again, you're subject to the order.
And that's still, if you ended up connecting with them via Zoom or something like that, it limited what you could do.
It did. I'll give you another example. We work with a few trade associations, and for many trade associations, a very, very significant part of their revenue is their annual meeting. So you can imagine if you had an annual meeting scheduled for April or May of 20, that meeting had to be canceled. And you could have lost a very significant part of your revenue. Well, you likely qualified both ways. You likely qualified because you had a 50% decline in revenue, but you also qualified because of the restriction on group meetings. And so I do want to point that out as well, that you can qualify through both doors. I've had a number of clients that had the gross receipts decline in the second, third, and fourth quarters of last year. But when they say, well, wait a minute, the government order went into effect in March. And, you know, the first 7 or 8 weeks of the first quarter last year, I was doing fine. And then boom, all of a sudden COVID happened. It's like, well, no, you were subject to a government order that last 2 weeks of March. We can go back and claim the ERC for your March wages also.
It's a great example, Larry.
And that would be even like if you have there's not a fee for service that you're doing, but you weren't able to have your meeting, it would still mean it was a decline in service because of the government mandate.
Right, because the way the IRS defines more than nominal, was a more than nominal part of your operation suspended. It's both it's revenue or employee hours. So if you're a service providing organization and you're providing those services via your employees, and your employees cannot do what they do, even though you provide your service, you don't charge your constituency a fee for providing the service. You're able to do that through the charity of your donors. That's still more than nominal part of your operations because of the number of employee hours.
Yeah, and those employees, in the way that the IRS has expanded trade or business to include basically all the operations of a 501c organization that's exempt under 501a, which is, you know, typical non-for-profit operating entities. And so, you know, that activity that they're actually doing, and the whole intent of this law was to basically encourage employers to continue to pay employees, even if they weren't doing the same work or as much work as they were previously able to do because of the pandemic. And so conceptually, as Larry just laid out there, a great example. There was a nice thing that popped up here in the chat, which is a good question, that basically posed and said, hey, if I had triple P2 and basically I, wouldn't be able to do the ERC in the first and second quarter, but maybe third and fourth of 2021, if I was eligible with the decline. So two things coming out of that. Abigail, great response. Yeah, we'll have to see what happens in quarter four, particularly with the bill that's sitting out there right now that would remove the ERC as a revenue raiser from the fourth quarter, which would be a super bummer for those that would be eligible. But back up in the first and second quarter, and this is an important point to hear, just because you have a triple P loan doesn't mean that you are not still eligible to potentially get the ERC. And so, using an extreme example, let's say that you had that revenue decline in the first and second quarter while you have that triple P2 loan that's in there and you're processing those wages. Well, the issue is you just can't double dip. So you can have both, and you can still receive forgiveness in the same period for triple P expenses that you use for wages, but you just have to integrate the two together. And so, if you had, the wages in the first and second quarter, of which would have been completely equal to the whole amount of the triple P, well, instead use some other covered costs and then use the residual wages, use them first for the triple P forgiveness, but then integrate in with the ERC and use, your rent expense, for instance, or certain other covered costs that are eligible for triple P forgiveness that Larry talked about earlier. So very important. It's not an either or,
It's both.
Is both. You just can't double dip.
Remember, your PPP loan was based upon 2.5 months of your average payroll cost in either 2019 or 2020 at your choice this year. That's about 12 weeks. Well, your cover period, the period in which you can expend those funds on forgivable costs, is 24 weeks. That's double. So you get twice as long to spend the money that you had to prove up that you needed the money. The other thing to keep in mind is that we were giving examples of employees making $10,000 per quarter. Well, let's say, for example, you've got some employees making $20,000 per quarter, $80,000 per year. Well, you can only use the first $10,000 of their wages for ERC. You can use the second $10,000 for PPP forgiveness. So there's all kinds of different combinations. And as CJ mentioned, we still have those non-payroll costs. The two big ones, or the three big ones, are interest on your mortgage, rent, and your utility costs.
Great example, Larry. And as Abigail chimed in here in our chat, thanks, Abigail, for keeping the chat answers going. I got distracted as usual, talking. And so thanks for keeping us moving, but it is complicated. And Abigail put her email in there. Feel free to reach out to us. We'll be more than happy to help. And in that same vein of helping, this is an interesting one that's out there. And this still lives on an optional basis here through the end of September 30. And I think it's important. The FFCRA, which really provided for two different types of credits that were out there. It was the Emergency Paid Sick Leave Act. So we called it the EPSLA credit. And then we had this EFMLEA. It was this expansion of under the normal family medical leave process. And so basically, without getting in these details, because we've already talked too many details, right? But basically, if you pay somebody, and now it's voluntary, this was pre-March 31st, it was mandatory. Now it's a voluntary thing. And so you've got somebody that comes to you next week and says, hey, you know what? I just tested positive. We've got this Delta surge going on right now. Well, what I would encourage you to do is, it's a really nice benefit because they get 10 days, if they personally have tested positive, they get 10 days of what's called EPSLA. So it's up to $511 a day based on their average daily wages in that example. And they can go and, rest up, and you can still pay them 100% of their wage if you want to, up to that 511, and then you get a dollar for dollar credit for that from the IRS. And so it's just something to kind of plant a seed out there. Hopefully you've heard about this. I've got a great picture of Don King. I'm a little bit of a fight fan out there, and he's one of the greatest fight promoters ever. He's out there. He's always promoting America and fights, right? You put the two together. And so he is a shameless promoter, and we have been shamelessly promoting the utilization of the EPSLA and the EFMLEA credits. And so, we're running out of time. It's optional from now through, basically mandatory, but as I mentioned, the second and third quarters of 21, it's an optional benefit, but please do it for your employees. This was a super, super beneficial thing that came out that really helped honestly limit the spread way back when, because a lot of people who need to work in order to pay the bills found themselves in a spot where, maybe they didn't go get tested, or maybe they showed up not feeling great to work because they're feeling pressure, maybe not as much in the nonprofit space, but, particularly wage earners that are, on an assembly line or, various other places. This kept people at home when they weren't feeling good and let them still get paid. And this is, again, this is a credit, just like the ERC goes through the payroll tax process. And so just shameless promotion here. Be thinking about this. It's a great benefit for employees. Doesn't cost you a dime. And honestly, you even get a pro rata piece of the health insurance that's attributable during the period. So it actually saves you money. And so great benefit.
I want to point out too, the other thing to keep in mind is the extended family leave. And I think this is going to be rather common this fall. So if you have a child under the age of 19 and their school is closed or their daycare is closed, the parent can take the day off and get extended family leave up to $200 a day. So I'll quickly mention that my grandsons have not made it through the first week of school, and they are home on a COVID leave because classmates have contracted it. So we're going to see a lot of that. If you have employees who have younger children, their daycare and their schools are going to be closing and quarantining for COVID. Remember, our under 12-year-olds cannot be vaccinated.
All right,
Larry,
so
wonderful.
so if you had not, like, let's say all of a sudden you're going, gosh, I wish I had known about this, or I wish I had thought about this. I had an employee that we did pay back in May who had to be quarantined, and we continued to pay their salary. I guess we missed out.
You probably missed out. I mean, you need to document it. You don't have to have a doctor's note, but you need to definitely document it in writing. And you've got to claim it on that form 941. Certainly much, much easier to do if you track it as you go along and claim the credit on the originally filed form 941. But you can go back and amend. If it's just a few $100s, it's not going to be worth your while to do that. But if it's, several $1,000s, it may be worth your while to do it.
Yep. And, that documentation process. I'm sorry, Ann. Go ahead.
I said, good to be aware of going forward, especially your example of your grandsons, because I think that happens a lot for those people with kids in school.
Yeah, I think there's the reality is, especially over the coming weeks, school gets back into play. You're going to see, and Larry, thank you so much. I got kind of caught up on the EPSLA. EPSLA deals not only with if you're sick, and I gave the $511 example, but also if you're taking care of someone who is not well and or is seeking treatment or diagnosis. And so basically you've got this process that's in place, or you just need to take care of a kid because they don't have childcare, because they're not in school, or their daycare is closed. And so you've got lots of ways to get in. We got a nice flow chart that talks about that one, similar to the ERC, but feel free to reach out to us. It does need to be documented, as Larry said. We've got a nice little form that we threw together that we used here at the firm. We shamelessly promoted this at the firm, didn't we, Abigail? And so we got a nice form that's out there, and you just kind of check off, here's what I'm held, here's what's going on, stick it in the file, process the credit, and then take the credit on the 941. So
it's a wonderful, it's this year, it's voluntary, as TJ mentioned, but it's a wonderful benefit to give your employees. I've witnessed this with my own family. Got a call last night at 8 o'clock. Hey, kids have to stay home from school. Well, what are we going to do? Someone's got to stay home from work. So it's a nice benefit you can give your employees. And I think it's greatly appreciated. Also, the government is really encouraging folks to get vaccinated. So if you do get the vaccine, you're not feeling well the next day, you're entitled to the sick pay. If you take the day off, you're entitled to the sick pay and the credit. And most recently, they've expanded it to say if you take time off to take a family member to get vaccinated, that qualifies for the family leave.
Yep. So it's real money that's out there. Document it, keep up with it, put it on that quarterly 941. And as Abigail mentioned earlier, her email is in the chat. feel free to reach out. You know, I mean, this is a lot of information out here, a lot of different things, but this is just kind of a survey of, I think, one of the main things that are not-for-profits and for-profit clients, honestly, really sophisticated, large employers, you know, that maybe have, you know, they might have been eligible, particularly moving in 2021 with, you know, under 500 employees. It's all wages. And so the ERC is a really great opportunity that's out there to take advantage of. You know, this is a nice flow chart. We sent this out to everybody. More than happy to answer any questions that you might have. But you got to ask yourself the question, is there any way I can get into door number 1 or door number 2? And of course, if you just started up, it's a whole nother conversation. But door number 1 or door number 2, be thinking about that 2019 base year, broad, you know, big, you know, particularly if you had big expansion of that baseline revenue, and broad application and the limitation of commerce due to the government orders. So, you know, good questions to be asking yourself. You know, don't let that money just sit there on the sidewalk. It's available, and you know, pick it up and use it for the wonderful purposes that our not-for-profits are carrying out inside of our communities. When you think about it, it's like, hey, this is money that we can use to further the wonderful services that we're providing to our different folks that are utilizing the great work that you guys do. I mean, it's really, really special. And so if we can put that money to use in a meaningful way, what a great use, because, you know, sure beats some of the other things we might spend our money on at a governmental level from time to time. So take advantage of it, utilize it for the purposes that you guys are carrying out. And thank you so much, not only for letting us be here, but most importantly, for the amazing work. And it is it's special to see lives changed, people touched, services provided, you know, hearts transformed, and mental health. You know, it's been a big conversation over the last couple of weeks. And coming out of the pandemic, I mean, I actually had somebody, 2 people in the last 24, 48 hours that have teared up and you know, really cried around the mental, you know, the stress and the anxiety of what COVID has done, be it in the political conversation, the vaccination issue, you know, the surge in Delta. And so, I mean, there are people need help, people need conversation, people need to process. And so, you know, thank you for the great work that you're doing to not only serve real needs from a material perspective, feeding, clothes, these things, but also a mental perspective as well. It's a real time where people need help. They need encouragement.
Thank you. And we've got Abigail's offered her email there in the chat, so you can reach out to her as you have questions. This just ends our time. Thank you. I know that there's lots of complex ideas and some things that you might just go, okay, that just went right past me. You got on this call for a reason. You felt like there was something there that you needed to dig into to see. So I want to encourage you, take that next step. Compare those numbers, ask Abigail questions as they come up, and get some help with this, especially if you're looking and saying, okay, I've already done PPP and we've already filed and we've got this other, it's worth getting an extra set of eyes on it and to help you. And I'm so thankful for the time that Larry and CJ and Abigail have spent in going through this with us. And we're going to end our time. If y'all want to hang on for just a minute, if somebody had like one question and wanted to ask a question or two, are y'all okay for hanging on for maybe about 5 minutes? If somebody just was like, we got right up to the end and I just needed to ask this, people can stay on to do that. But we're going to end, and we'll end our time together. So thank you so much. Lord, we ask your blessing as we go, and just be with each of these folks in the next steps that they need to take related to this. Thank you again for Larry and CJ and Abigail, and for the love of and the knowledge and experience and diligence with which they have done work, and that we might benefit. Thank you for that. In Christ's name, amen.